But I'm very happy to have you here and to introduce you, Brian Wieser, Global President, Business Intelligence.
Sounds right.
About right.
I mean, yes.
A very smart person.
It's precise as one would expect from you.
Yes. Thank you very much. Thank you very much. My brain has not melted fully yet. But it's great to have you here at the beach. It's great to kick off this week together with you, because I think we're all at the moment in a little bit of a strange period, a strange situation. I'm going to play a little bit the devil's advocate here. We might face a global recession. We have interest rates as high as in 15 years, I think. We have inflation higher than 40 years ago. Where are the good news, Brian? Tell us.
There is good news. And for those of you, first of all, thank you for having me. Thanks to RTL for doing this. For those of you who know me, you may know I'm normally a bit, shall we say, cynical. Yeah, contrarian sometimes, but usually it's because I observe that in good years, people are like a little too optimistic on certain things, and I try to bring people down to earth. And I find myself in the odd position this year of having to go the other way.
So you're the motivator. You're the positive guy now.
I mean...
So what does it say about the situation if you're the positive
Snap, guy? Just to give an example. As a securities analyst covering stocks, right? Snap was a stock where I had to sell on the IPO. I think I had a $10 price target. Everyone else like super bullish, assuming to the moon, right? Okay, over a period of time, it crashed down to like $4. Well, my price target changed to like 8, and I became suddenly the biggest bull. And all of a sudden, I'm having to justify to Muhammad Al-Aryan why this isn't a nil value business. Now, I stopped covering it before it went, in its most recent tear all the way up. But my point is, I like to think my underlying premises around how the world works stay relatively consistent, and everyone is inconsistent around that.
So give us a bit of a framework here. How does the world work?
All right.
Inflation, interest. We have a war in Europe. So what is the reference point? How do you cope with this situation? Yeah. And what is the reference point you're referring to when you say we need a little bit more of a more realistic view on things?
So there's a few moving parts here. First of all, economic variables have or can have some correlation with advertising-related data, but they don't always have correlations. Take consumer sentiment. So the University of Michigan Consumer Sentiment Survey, for the US at least, is certainly the most widely relied upon that I know of. I'm not sure what the dominant European one is, but I dare you to correlate that to anything. Find it. Show me the correlations. Now, right now in the United States, the Michigan Sentiment Survey is lower than it was during the global financial crisis. It's not that bad.
But what can we base our views then on?
Okay.
Like what is the, as I said, what's the reference point? How do we get to a more realistic view?
So you're German, right?
I have to disclose, yes.
Okay.
German.
Now, as I was saying earlier, my name is actually Austrian. So maybe that precludes or predisposes me to wanting to talk about Joseph Schumpeter.
Okay.
Schumpeter is the guy who coined the phrase creative destruction. No, he's not talking about getting rid of Ogilvy and Mather or McCann Erickson. Creative destruction was the idea that new business... Come on, laugh lines. Anyone? Come on.
They all studied economics probably at one point, but they forgot it.
Well, at least they studied...
Between the rosés and everything, they forgot it.
Okay. Anyways, creative destruction is the idea that new businesses form and effectively replace those which go away. And that shapes the composition of an economy. Imagine a world where you had, let's just say, nothing but booking.coms emerging as a form of travel booking, replacing Thomas Cook's. I think we all know what that would do for the advertising industry. There may be no more being spent on travel, but what does that do for advertising? Massive expansion. Now, to the point that we try to look at economic variables and try to correlate that with advertising, sure, you can find correlations, but correlation is not causation. At best, it's usually a proxy for something that's happening. And importantly, if you do look at correlations, they can change over time. The relationships between different variables can change over time. If they are proxies, they become weaker or stronger.
But what is the framework? What is the proxy that we can use to assess where we are at the moment in the cycle?
Admittedly, there's more art than science in the short term. I would argue that, yeah, if you've got no other basis for a longer term forecast, GDP, sure, fine, whatever. But here's the thing, in many countries, you'll find that there's almost no correlation between GDP and advertising. Now, it's still not a bad barometer to say that if in 2027, you think like a steady state kind of nominal growth rate for a given country is like 4 or 5%, unless you've got a reason to believe there's a structural decline in advertising in that market, or there's a reason why there's structural increases, and you can point to what secular factors are that are causing that up and down relative to that number. I mean, that really is what should drive that longer term number. In the short term, feel can be as good as a way to anticipate where the market is going. Now, I would say that when it comes to our numbers, so just for point of reference, we published a forecast this year, next year. Also, we have a podcast called This Week, Next Week. Get it wherever you download your podcasts.
You can skip the 40-page read and the big Excel files and just listen to you and your colleague.
But, so if you were to look at the data, you would see that we forecast in December 9.7% growth for 2022 on a global basis. If you look at our data now, it says 8.4%. Couple of variables. Now, is that a worse number than it was in December? Yeah, that's a short way of answering it. But keep in mind, China, 20% of the global advertising market, down from 10% growth in December, 3% now. Right there, that explains all of it. It kind of does. But you could also argue inflation expectations in December for this year would have been about 3%. Instead, expectations now are called for 7 globally. So an 8.4 now is worse than 8.4 in December. So it's not like we're uber positive, but when we go country by country and we look at the fact that around the world, advertising actually grew by 15% approximately in the first quarter. So we've kind of already nailed a good chunk of that 8.4.
But let's break that down a little bit. You know, 8.6 global, right? Now we're in France here. Give us a little bit of an idea in Europe. What can we expect this year? And which medium is the driver, or which medium on the one hand, and which sectors and industries are the drivers?
Well, so in most countries in Europe, we do have high single digits. Now, keep in mind, because we are basically saying there will be real underlying, like inflation-adjusted economic growth, in lieu of any other variable to inform this, and that means that there is basically some growth. Inflation, in our view, is basically additive. Inflation is not negative unless inflation causes interest rate tightening to such a degree that it contracts economic activity. We're arguing that the kind of interest rate rises we think will happen will not contract economic activity in a meaningful way. The economies around the world can still tolerate more interest rate hikes without causing contraction of activity. So with that said, if you're a typical packaged goods marketer or many categories of marketers, you budget for your advertising on a percentage of revenue model. If you anticipate, and you just go through the earnings call transcripts for any large advertiser. Now you'll see some who say otherwise, but the majority would say, we see inelastic demand trends from consumers. There's a tolerance, they don't like it, but there's a tolerance for higher prices. They will pass those costs along. If you know that a company will see 5, 6, 7, 8, 9% revenue growth, most of them will increase their advertising budget by that level.
And I think, you know, to join a bit your side of the story, I also think that we must not underestimate that in the last 2.5, 3 years, consumers saved up a lot of money, right? So we were just talking about this. I think the average savings rate in Europe is as high as it has been since 30, 40 years, right? So there seems to be a little bit of a buffer on both ends, on the consumer end and on the manufacturing end.
One thing I'd watch for, so there is a concern that inflation disproportionately hurts some people, lower income people, except for 2 things. At least in the US, the lowest decile of wage earners are seeing wage increases in excess of inflation. And in the UK, I think
excess of 8%?
Yes.
Okay.
Now, part of this is the fight for 15 and efforts to raise minimum wages, but also it's a tight labor market. Why is it a tight labor market? Because there's too much demand relative to the amount of supply. In the UK, the lowest quartile is experiencing higher wage gains than inflation. That's not true in most of Europe. But that said, if in Germany you're seeing like 4 or 5% wage gains, even if inflation is like, 7%, okay, it's not optimal, but it's not as bad as it might look.
Yeah. And I would argue that do we have a point of reference in the history that you would compare the situation to? Because I try to think about situations, the doomsday people, they call out for a Weimar Republic, hyperinflation, stuff like that. But this combination out of, we have inflation, but now the interest rates go up, unemployment is super low.
Yeah.
It's a pretty unique situation as well, right?
May I say, by the way, if anyone can help get my hands on Weimar Republic era data on advertising in Germany, because I've actually tried to look for
really
pre-Franco era Spain.
I'll look into that. But I'm not sure if it's recorded.
I mean, it's
20s.
You're raising a really interesting point. Few people have a proper grasp on history and the lessons that might have been learned in our business, largely because maybe the data wasn't captured, wasn't recorded, people thought it wasn't important. As advice, because you're all asking for advice, right? Okay, I'm going to give some. If you ever have a spare 3 or 4 or 5 days, go to whoever your dominant trade publication is in your country. Find archives. Go bury yourself in the library of whatever entity has that. The 4A's has like all of Ad Age back to the 60s, and I know you can find Campaign going back to wherever, in certain places. Read the history, and you pick up so much that's relevant today.
I think, if I look at that period from, that macroeconomic view, I think we're in a period of adjustment, right? I mean, we have been living with zero interest rates or minus interest rates for 10, 15 years. Now we have to just adjust to normal or to levels that we had before, right?
Right, and that's part of the trick. One of the many tricks in trying to anticipate how the world will evolve. Nobody has ever seen anything like this, right? There has never been this pace of, Jamie, that was a QT, quantitative tightening, paired with this kind of inflation, paired with impossible to identify permanent versus temporary changes in consumer behaviors. There's so many oddities in the data. And that's why I come back to this idea, like, you can take any set of data, torture it enough, it'll tell you anything that you want. Your feel will ultimately be a better guide, but it's critical that feel is independently formed, right? Look at the raw data yourself. Don't just say, well, everyone else says we're gonna have a recession. It is true that we could talk ourselves into one. But to the extent that you're saying you believe something is happening because you've gone to the underlying data that everyone says is driving this, you've looked through some other ideas that you think might be possible factors, and you formed your own conclusion based on your feel. That is a valid way. That is, frankly, how most analysts do and should forecast.
Probably this self-fulfilling prophecy is the biggest risk.
It is a real risk.
If everybody believes in it, then everybody makes it true at the end of the day. But I want to come, 2-3 words on which sectors do you believe will be hit most in the current period, because capital is expensive, right?
Yeah.
And which sectors do you think will have a reasonably okay time or even a good time?
Well, I mean, it's hard to say with a lot of precision because unfortunately the quality of data to be able to answer this sort of thing is not very good. We do know that there are a ton of companies out there that were, they raised capital with nil cost and they deployed it. Did you ever hear about my crazy business idea, by the way? And we kept
Which one?
Okay, this is on the podcast this week, next week. We talked about this like in January, February. We said, this is seriously, when the markets were still robust. I said, okay, I live in Portland, Oregon. Here's this great idea I got, okay? I'm going to go down the street to my neighborhood bank because they're giving away capital. I'm going to go get $1 billion because, anyone can go get that now. I'm going to then get my car, drive up the road to Seattle, go to the Boeing plant. I'm going to say, hey, Boeing, can I have 4 airplane fuselages, please, for, I don't know, $900 million? Okay, then I'm going to get back in my car, drive down Silicon Valley. First of all, I'm going to set up a website. I'm going to spend $50 million on advertising, $50 million setting the site up, make it look really good. and I'm going to sell the airplane for $700 million. Now I'm going to go down to Sand Hill Road and say, all right, look, I've got a 700 million GMV. Right now, current multiples, that's a 10x multiple on GMV. I'm worth $7 billion. I'll take $2 billion of cash money. I'll pay back the $1 billion loan. I'm sitting on $1 billion. What do you think?
Why didn't we do that?
This is not far from how the rapid delivery business was working. Okay, this was never going to be sustainable. In our December 2021 forecast, we called out this was a real risk around deceleration. Nobody should be surprised, but they are.
Well, I think, to me, it all started also with WeWork. Remember that pitch, like how much money did SoftBank put into that?
Googobs.
I don't know.
That's a technical term for Wall Street.
It was a giant amount, and the guy at the end gets quite a substantial amount of money to.
In Masayoshi Son's
not
defense,
a tech company, but
in Masayoshi Son's defense, one thing I've observed from my time in Wall Street, as long as you're consistent, when everyone else is inconsistent, you will make money with a long enough time horizon.
In the long run.
Give it 100 years.
But it's not a tech company, huh?
Well, no.
It's a rental,
but that's beside the
space
point.
rental. But anyway, so now
categories to the upside. You did us categories to the upside. I don't know. I think that it's those that which actually are, like packaged goods could very well do okay. I think that luxury continues to do really, really well, despite everything going on.
In your podcast, you said that you do believe that with the rising inflation and products getting more expensive, companies also need to invest more into advertising because they need to tell the consumers, listen, you still should buy my product, right? So that could be also a driver for advertising spends,
It
right?
can be. I mean, again, it presupposes that there is some real growth, whatever that means. But yeah, I mean, Kellogg's CEO said this on an earnings call sometime last year, because in an environment like this one where they need to persuade people not to trade down, because they know that there is a willingness to pay up, if you can persuade them, justify it, that can be a reason.
Now let's move to us, to the broadcasters, media companies. I remember we had a conversation a while back when RTL Group launched the strategy on national media champions, and you were a little bit critical around it.
Very critical, I thought.
I'm on camera, I have to say a little critical. You can say critical. But anyway, now what we are trying to do here with Smart Clip, with Gunnar and Ja, and with RTL Ad Connect, trying to build an international media sales champion. What's your thoughts on that?
That I like. All right, so
why do you like it? Tell us more.
No, but here's the thing. The criticism, we've written about it a fair amount, we talked about it a fair amount. The problem of organizing businesses as national champions is that you're investing against a single market when the competition that's coming from America is investing against a global opportunity. And so when we look at the sheer scale of investment that we'll see in original content, whether it's in Germany or France or South Korea. And I was saying this before Squid Game. Do you know how much Netflix spends on South Korean content? It's like $500 million a year. The domestic players alone spend about $500 million on their streaming content, but they don't have the ability to amortize that cost over a global cost base. The good content plays well globally, right? And I think about like the knock on German content was that it's not very good. Well, it's because it was investing against a small market. But when you play stuff for a global market, like, oh my God, like that series, what was it called, 1984, 88?
Yeah.
I mean, some
Fremantle, we have Fremantle here.
Great German properties, right?
Yeah.
Anyways, but the point is that the opportunity is clearly global. And that speaks
also on the advertising
side too.
That's what I'm trying to
But
get at,
that's
because
where
we're here to sell some advertising and some inventory, right? So tell us why this is good.
So marketers are increasingly oriented around global opportunities. Now, to be clear, the vast majority budget today at a country level. But the opportunity should be to apply best practices and learning and figuring out what works and doesn't work in one place or another. Global marketers are more advantaged than single country marketers in the world that we have. And we're not at a place yet where a streaming service launches in Germany, and it's also in France, and it's also in the UK, that a budget is negotiated globally. But I think that can be an advantageous way to go.
And from the agency perspective, do you see that mirroring, that
Clients
advertisers are looking more for a global centralized approach rather than decentralized?
Clients tend to pick agencies on at minimum a regional basis and often on a global basis. So there's definitely the marketer who wants consistency of service is more likely to want a global agency.
Okay, we're just going to continue to talk until Coraline stops me because I have so many questions. Okay, so, but this is true for global advertisers, right? How do you see global advertisers, the big ones, versus small, medium enterprises? What do you think is going to be the relation in the future?
Well, here's the funny thing, and back to the debate we were having earlier about whether or not economic activity correlates to advertising. So I'm sure there's people from many different countries here. I'm sure every one of us has seen a local politician say something like, small businesses are the lifeblood of the economy, right? We've all heard this? It's not true anywhere that small businesses are taking share of an economy. Large businesses, use OEC data or anything else you want, any consistent measure, large businesses take share of economic activity for better or for worse. If we think it's a good thing for small businesses to take more share, well, politicians are failing. But take it as it is, that large takes share. However, small businesses have new opportunities to whatever.
To get big businesses.
No, well, they can. Randomly, that will happen. But small businesses can operate globally better than they ever could before. And so to the extent that digital platforms are disproportionately well suited to help them do that, that's a positive thing. It's consistent with the evolution of business as a much more global, ex-China, industry.
So we've covered the advertising industry, we've covered the media partners, the us. What about the consumer? Like, what do you expect media consumption to go? Which direction? What are the trends that you guys are observing and you're seeing on the consumer side?
Yeah. Well, I mean, the first thing is to understand how the advertising industry is evolving in terms of total growth. Because consumers typically don't spend any money on advertising, how much time they spent doesn't actually drive anything. With that said, every marketer wants to find ways to better engage with consumers. Frankly, obviously there's increased consumption of different digital platforms. Digital is kind of ubiquitous. I think we all know that. Streaming services that are ad-free or ad-light are taking share of ad-supported ones. So that has all sorts of implications about the utility of television in terms of reach and frequency being useful metrics. Now we could argue whether or not it is, whether or not it should be. Now we could speak more to the opportunities that marketers have to change how they look at data and metrics.
I mean, for us, a big topic is, and we'll talk about it tomorrow, is what we call the new life of the living room, right? And everything that's happening on the big screen, and how consumers are really using the space, the living room, to come together to have a good time. And most certainly what is going on the big screen is changing, but that place has become more and more important during the pandemic, and also referenced with good memories now, families coming together, etc.
This is true. May I just say on that one point, even if consumption of ad-supported television fell in half, it might still be 5 times more effective in accomplishing a goal.
That would be my question now. So looking at that, we believe, the big screen, that's where the magic happens. That's where the impact is generated, right? How do you see advertisers, agencies looking at prices and paying for impact? Or we have Karen Nelson-Field here this week talking about attention and how attention drives impact and how impact should be
it should be, except impact can be so subjective in terms of how it's defined, what the KPI is that the marketer has. The one thing I'll say about price that's worth noting is that at the end of the day, budgets are typically independent of price. Pricing is an output, not an input. Yes, from a seller's perspective, I get that the way sellers manage inventory, it's clearly an input. But at a macro level, it's not. So if you end up having a situation where there's a certain amount of demand at a certain time that causes prices to spike, or for whatever reason your selection of marketers or marketers who want your property end up leading to inflation, That happens. But the budgets are independent of that. Inventory will be managed differently to fit the budget that's available. So in a sense, it doesn't matter.
It doesn't matter from the top. You
It
mean
matters.
like,
Well, to be clear, it matters to
from the
clients.
budget perspective of the advertisers. I fully get that. But the question for us obviously is more: how will that be distributed? And are advertisers and agencies willing to take more inflation, to take bigger prices for bigger impact?
I think that the bigger problem is that marketers need to invest more in understanding why their goals are what they are and how they can adapt those goals as the utility media changes. As if supported reach and frequency becomes harder to accomplish, maybe reach and frequency aren't the right metrics. Maybe different metrics are needed, and therefore, frankly, more research is required to understand what the right metrics are. And then pricing may be a moot point.
Yeah, I mean that's exactly the route we're trying to take in order to find out more and to, create more insights that help advertisers to take that decision. I think we've come a little bit to the end. I have one more question. I know you've been.
Oh, we got a question
yes.
from the floor?
I have
Sure.
I have one more because I know you're coming from the financial analyst side. What's the stock price at the moment of WPP?
I haven't looked today. Why?
Does anybody know? Can anybody look it up, please? Just quickly, what the stock is from WPP.
Uh-oh. Where are we going with this?
Nobody has WPP shares?
You look at
My
I don't
God.
look at stocks every day. I'm a long-term investor.
49?
That's the ADR.
Okay, so what's the stock price in next year income of WPP?
No, that's not a fair question. No, I mean...
What I'm trying to get at is, do you believe that the current situation and what we're going through will affect the agency world? And if so, in what way?
Agencies always adapt. I mean, the thing that's unique about them is because they're so human. I mean, for better and for worse, they're very human. That they're more adaptive than most things. They're not dependent on a product that is not people. So the world can change, and so can agencies.
Thank you very much, Brian. If you want the stock price, you have to go to him privately. I guess he didn't want to disclose. But thank you very much for being here. Thank you very much for this bird's eye view, this outlook on where we are. And I look forward to this week and to have more conversations about it. And thanks for having a glass full, half full mentality on this one.
Anytime. Thanks for everyone.